This video is short, but I promise at the end of it, you will know how to invest your money in stocks to gain a massive 500% return within a relatively short period like I did. So watch up to the end. First, make sure that you put aside an amount of money that you do not need for at least 3 years. If you have debts, pay them off before you even think about investing in the stock market. This is not financial advice. This is only what I do with my money. I am a random person who you just met on the internet, and I don't have any professional qualifications to be your financial consultant. Let's begin. Open an account with your favorite broker or bank that allows you to trade stocks. Look for one that offers the lowest fee because you will make a good number of trades and you don't want to spend more than you need to trade your stocks. Transfer the money to your trading account and you are ready to invest. Some banks may offer free trades or other financial incentives for opening an account with them. There is no harm in taking that opportunity. Shop around online, just don't open an account with a bank where your wages go or where your retirement fund is. Do your research to save as much money as possible on trading fees. Make sure that you choose a cash account, not a margin account. You don't want to use margin because you will receive a margin call if the market fluctuates and the value of your holdings plummets below your initial deposit. Your investing experience should be quiet and noiseless, so you don't want to receive a margin call. It is traditionally dangerous to enter the stock market when stocks are hot. The market is having a bull run, and everyone is talking about a good time. But for this strategy, you can enter the market at any time and make the best of it. Even during a bull time, not all the sectors of the economy are rising. Thus, there is bull time for tech, real estate, energy, materials, or consumer discretionary, etc. That is how, during the height of tech stocks, we saw a massive decline in energy stocks. Your first job is to find a sector that has fallen already and is consolidating for at least 3 months. You can get this information by going to the S&P Global website. The page looks like this. On this page, you see 8 major sectors and their annual growth or decline. You see in April 2023, the consumer staples sector was high, but the financial sector was low, and in October of the same year, the energy sector was high, but the industrial sector was low. When a sector is low, most companies within that sector decline in value, including the best companies. Do not look for a company that has declined in value, look for a sector that has declined in value. An individual company may decline in value because of a bad investment, lawsuit, political decision, scandal, or whatever. That decline may be directly related to that company. But when an entire sector falls, it is not the fault of an individual company if their share prices fall. That is where you come in. I made most of my money in the energy sector. See what happened when oil prices fell because of COVID-19. Great companies lost 80–90% of their stock value. When you take an opportunity like this, you are bound to make money. I'm not talking about 10% or 20%. I'm talking about 3, 4, or 5 times of your investment. Now that you have identified the sector, find the most solid companies in that sector. It is the best companies that will bounce back faster and higher when the sector recovers. Stay away from small caps or even medium caps. Find the best 5 companies that suit this criteria and be ready to invest. Now, how are you going to know when to enter? Go to barchart.com and open the ticker of the stock in the interactive chart. Use the daily chart and apply 2 moving averages, 50 period and 20 period, on the chart. Enter the market when the daily candle is green and ends above the 20-period moving average, and when the 20-period moving average is above the 50-period moving average. Invest in your selected 5 companies, but only half of the amount of your investment. Keep the other half in case the market goes against you, as it can well do so because the market is highly volatile at this moment. You will invest half of the rest of the money only if the market declines by at least another 20%. You may never have to invest that money, but if you have to, take it easy because the new trades will lower your cost average and offer you a better return when the sector recovers. If you want to be successful in the stock market, you will have to have a lot of patience. Greater profits come from greater patience, and I cannot stress that enough. Now, when to exit your positions and how. Most likely, you have invested only half of your money, or at best, 75% of your total investment. Keep an eye on the market looking for the next opportunity. While doing so, exit half of your position when the sector recovers 50% of its previous average price and pockets some profit. Let the rest run to maximize the profit from that sector. Enter a new sector only when the sector has fallen and consolidated with the profit and the rest of the initial investment. Remember, you never get into the market with all of your investments and all at once. You do it step by step and only when an opportunity offers itself. You have to be a responsible investor by not gambling with your money and by not choosing to invest in very volatile stocks to be rich overnight. Getting out of the market with a smaller gain is much better than losing your capital and not being able to invest again. Be reasonably conservative while selecting your stocks. One strategy can be looking for the PE ratio or price-to-earning ratio of the stock that you would like to invest in. You can get that by going to Yahoo Finance. Search your stock and then go to the Statistics tab to see the valuation of the company. There, see the PE ratio, trailing PE or forward PE will do. You are looking for a stock whose PE ratio is under 10. If you are like Investor Templeton, you might even look for a PE ratio of 5. A lower PE ratio means it is a more value stock and your profit margin will be higher. On the same web page, you get some other useful information. For example, the market cap of the company and its enterprise value. If the market cap is lower than the enterprise value, that is a good indication. That means the company has enough hardware or assets to survive the downturn. If you scroll down the page, you will see the balance sheet of the company. Here, you can find how much cash the company has and how much debt. You are looking for a company that has high cash flow and low debt. But sometimes, a very good company may have low cash in hand because they invest in innovation and expansion. They don't hold on to their money as long as they have a healthy cash flow. So this information may not be that useful. Also, see the book value per share on the same page. If the book value is higher than the market price of the stock, that is another good indication. Most of the time, the market value of a stock catches up with its book value. If you select good companies, they will surely catch up with their book value sooner or later. Hopefully, now you have enough knowledge to understand how you can do what I have done. Jump from sector to sector, and soon you will see you have made 500% or even more. However, always bear in mind that the stock market is unpredictable, and a sector may require more time to recover than you think. Many national, regional, social, and political variables may impact the market, and you may not receive the desired percentage of return on your investment. That is why never invest any more than you are ready to lose. If you like this video and want to see more investment and personal finance videos in the future, don't hesitate to subscribe to this channel and help it grow. Happy investing. Thank you.